Hey guys, in this video series I'm going to take you through a 7-part model of how the Forex markets work. So to be clear, this isn't the basics. It's more like an in-depth guide designed for traders so you can get a better understanding of the different things that are going to influence the price so you can make better decisions when you're trading. If you don't know me, my name is Sam Eder. I've been trading and working for major global brokerages for the past 16 years. I'm the CEO and co-founder of MarketMates, and we use this model of the markets at MarketMates all the time. Personally, I'm a day trader and I focus on trading USD yen. The first part of our 7-part model is the price. And the price forms the building blocks of our model. And this is because it gives us this deep understanding into market psychology, which helps us understand where the market's going to be heading next. And what we're looking to do is be able to bring up a chart at any time and in a very clear way, understand what the price is telling us. And we're looking here for timeless and universal principles and tools. So ideally that chart that we bring up could be on any currency across any time frame. And we can look at it, assess it with these tools and get ourselves an accurate picture about what's going on. The first part of understanding the price is determining the direction and the volatility of a currency pair. So if you think about it, the price either goes up or down or sideways, the direction, and then there's the volatility. So that's how rapidly it goes up or down. So does it go up fast? Does it go up slow? And if you look at a chart, you should be able to look at it and determine at any particular time what sort of trend we're in and what the volatility is like. And this guides our trading decisions. So you can see here this chart where I've pretty roughly drawn the trend. So we can see we're bullish in the first part and bearish in the second part. And these periods where volatility increases. And this is important for us because it has a huge impact on what's actually going to work at that point in time when we're trading. So we can categorize the trend and direction into market types. And hat tip to the late great Dr. Van Hart for teaching me about market types because it completely changed the way I thought about trading. So when we have market types, they come in 2 parts. So you have the direction or the trend, and you have 3 categories here. You have bullish, bearish, or sideways. You can see that on the chart. So the bullish, the market's heading up, bearish, the market's heading down, sideways, the market is, well, going sideways. And then you have the volatility. So volatility, again, you can see here on the chart, starts with quiet, where the market is not moving very much. Then you have normal volatility, which is a normal amount of movement. And then you have these very volatile periods where the market is moving around rapidly. And what you do is you combine these 2 together and that forms market types. In our model of the market, we use 8 different market types. So we have bull and bear normal market types. These are upward and downward trending markets with normal amounts of volatility. You have bull and bear volatile markets, and these are upward and downward trending markets where there's more volatility. So in a bull market type, for example, you might see this rapid move, which often occurs near the end of a trend. That would be a bull volatile market type. You have sideways quiet market types, which incidentally, my favorite market type. These are where the conditions are very tight, the price forms a range, and then you often see a breakout from this range. Then you have sideways normal market types where volatility is normal, price is moving sideways, and you have sideways volatile market types where the price is moving in a wide range sideways. And then the final market type we have here is extreme market type. So these happen occasionally, and that's when you get these really rapid, dramatic moves in very short spaces of time. So you might get a few hundred pips move in a few minutes or something like that. And we categorize these as extreme market types. You can see here some market types on the chart. So on the left of the chart, we have a sideways quiet market type. So the price has formed a tight range. And what we're looking to do is match the strategy to the market type. So typically when you see these tight ranges, it acts like a coiled spring, and then you see these dramatic trends or moves. So the correct strategy in this case typically is trading breakouts. You have the bull normal market type where the market is rising on the left-hand side of the chart. And the correct strategy here typically is buying on pullbacks, maybe buying breakouts to new highs. At the top of the chart, you can see a sideways normal market type where the price is moving sideways with a normal amount of volatility. You can compare that to the sideways quiet market type. You can see it's quite different. And then you have the bear normal market type where the price is trending downwards and the correct strategy here might be selling. So I'm going to briefly talk about a method for identifying the market types. But what I want you to understand about this is the method is not so important. There's lots and lots of different ways to identify the market types. What matters is that you have a method. So this needs to be something that you're constantly assessing when you're trading. The exact method doesn't matter so much. But I'll show you the one that I use. And if you want more detail about this, then there's a lot more information about it in our advanced course for smart traders. You can join up that at the bottom of this video, completely free, always will be free. So to identify the market type, the tool that I like to use is the Bollinger Bands. And then I will use variations of the Bollinger Bands. So I use the Bollinger Bands relative width indicator, and I also use the market type indicator. And the market type indicator is something a friend of mine developed, and that helps measure the market type. And it uses Bollinger Bands and RSI, so a combination of the two. And again, you can get that for free. They're all available from us on TradingView. You just need to give us your name. There's a link to do that below the video if you want it. So you can see here on the chart, we have the Bollinger Bands. If the price is trading below the mid Bollinger Band and between the lower and mid Bollinger Band, then you're in a bear market type. If it's trading above the mid Bollinger Band and between the upper and mid Bollinger Band, we're in a bull market type. And then you have these periods where the price is trading around the Bollinger Band and the Bollinger Bands are sideways. And then you have below this the relative width indicator. And here I use this in particular to identify when we have a sideways quiet market type. And this gives me a no questions asked definition of exactly when we have a sideways quiet market type. So it takes all the ambiguity out of identifying sideways quiet market types. So you can see when the indicator's below the red line here, it means we're in a quiet market type. So this one helps measure the volatility. And below we have the market type indicator. So this is a very simple way of determining the trend. So you have when the price is above the midline, you have a bull market type. When it's below the midline, you have a bear market type. There's a couple of other factors to it here, but that's the essence of it. So the idea is you have this way of assessing what the current market conditions are, what the direction of the price is, and what the volatility of the price is. And that's our market types. And then we use that to determine what is the correct trading strategy for the current market conditions. And that could be your entry strategy or it could be your exit strategy. Now, there's a lot more to our price model than just market types. This is one of the tools in our toolbox. So I'm going to cover a few more tools that we can use next. The next thing that traders need to understand about the price are overbought and oversold conditions. And these are conditions where the market is likely to reverse, or there's a chance that the market will reverse. So typically what happens is there's a strong trend, and then at the end of the trend, the market runs out of buyers if it's a bull market or sellers if it's a bear market. Sometimes there's a large one-directional move as the markets get quite illiquid because no one wants to trade against the trend. And then all of a sudden, the markets rapidly reverse. And it's important to understand these conditions because if you're in a trend, and this has happened to me numerous times, if I'm in a trend and I'm not aware of when the market gets overbought, for example, then I end up giving back a large chunk of profits. Whereas if you're aware of these conditions, they allow you to make good decisions about what to do, such as take some profits. Or if you're looking for contrarian opportunities, then it can be good not to trade against a strong trend, but wait for a trend to start to run its course and reverse, and then you get these contrarian opportunities. And contrarian opportunities tend to be the best risk-reward ratio opportunities available because you're getting in right at the start of a new trend. So it's important for traders to identify overbought and oversold conditions. And you can see here an example on the chart. So you have this bullish trend, you then see this rapid price movement and this reversal when conditions get overbought. And you can measure this here by using an indicator. So for example, RSI is a very good indicator for determining overbought and oversold conditions. There's lots of other tools for it. So I would encourage you just to use one tool. As I said, I like to use RSI. And in fact, the market type indicator that we have has RSI built into it. So it also serves to measure overbought and oversold conditions and when those conditions are about to end and reverse. So I've found that incredibly useful in my trading, and I use that every day. So understanding overbought and oversold, really important tool to have in your toolbox as a trader. The next tool that traders should have in their toolbox when it comes to the Forex markets is candlestick patterns. So candlestick patterns have proven to be timeless and universal. They apply on almost any market and any time frame anywhere, and they give that insight into market psychology at that time, and also very importantly into buying and selling pressures. And this can help in Forex, and it often leads to not just short-term momentum shifts, which candlesticks provide a great insight into, but sometimes it can give us insight into longer-term changes in trend and direction as well. So I definitely like to include these as part of my model. What I'm looking at is a few particular patterns, and I'm not going to give you an extensive list here. There's heaps of information around on candlestick patterns. I just encourage you to go away and figure it out. But the ones that I find most influential and form the core of this part of my model are evening stars and morning stars. We then have bearish and bullish engulfing candlesticks, both against support and resistance levels or off support and resistance levels and during trends. And perhaps my favorite are shooting stars and hammer candlestick patterns. So these provide great insight into changes in momentum and direction. And I think they're particularly important for Forex traders to understand. I'll also add that it's worth looking at the size of the candlesticks, because long candlesticks can give us some nice insights, and not just the length of the body, but the length of the wicks. These can help us understand how volatile the market conditions are. And short candlesticks are also quite important to see as well. So just looking at what the current state of the market is with respect to candlesticks is also valuable, not just looking at particular patterns. The next element of the price model is simple tops and bottoms. So for the purist out there, I'm not talking about your classical technical analysis, double tops and bottoms. I'm talking about a more simple version. So what I'm talking about here is rejections of new highs or lows. So if you have a trend, let's assume we have a bear market, the price is going down, it forms a low. Normally there might be a bullish candlestick pattern at this low, and then the price will head up a bit, and then it will go back down and retest the low. And when it retests that low, if you get a strong bullish candlestick pattern, that can be a sign that market conditions are about to change. It doesn't necessarily mean we're going to see a bull market breakout, but often the trend is ending there and you're going to see a period of sideways movement, if not the full reversal. Of course, sometimes the market just continues to go down anyway, but it is a clear warning sign, and we can play this probability. And if it does break through the low, if you get no rejection, then obviously the trend is continued. If you get the rejection, then we've got this early warning signal that the market type is about to change. And of course, the same applies for bull markets. So when the price goes up, you see this bearish candlestick or this new high made, you see a sell off, a retest of the high, reversal pattern, and then the market doesn't make a new high and you've got either a bear market occurring or you've moved into a sideways market type. So this is really important. It happens all the time. It happens on multiple time frames. Obviously, the higher the time frame, the more impactful it is. But I use this every day in my trading. And if I'm in a position and I see one of these patterns form, then typically I'm taking some profit, if not exiting the full position. So we have a couple of examples here. You can see in this chart a double top and a double bottom that have really clearly determined when the trend is finished, and in both cases when a new trend is breaking out. So you can see the first rejection followed by for the double top, you see the first rejection followed by some bearish candlestick patterns. For the double bottom, you see the first rejection, another attempt with some bullish candlestick patterns, and then the price changes. So you can see how influential this pattern is, and it should form an important part of the price part of our model of the market. In this final example, this is actually New Zealand dollar versus USD. We have this formation of a simple double bottom where we have the low and then the rejection of the new low, and bullish candlestick patterns form, and then this rise. And this actually predicted for us around a 1,000 pip move. This is a very large move. So as I said, on the higher time frames, it's particularly impactful. So you should definitely take note. And I think these are great longer term contrarian trading opportunities for traders to think about on a practical level. The final tool in the toolbox here for price is support and resistance. And support and resistance happens all the time in Forex markets. It's super common, so it's something you definitely need to keep your eyes out for. And the reason why it's so important is these levels act as reference points, so traders use them often as reference points, but there's also a lot of orders typically sitting around these levels. So there's lots of supply and demand. And we'll talk about why that's particularly important in the next part of our model when we talk about dealing ranges. But as a basic overview, if you think about Forex markets, or really any market, it's supply and demand that moves the price. So if there's more buyers than sellers, then the price is going to go up. If there's more sellers than buyers, then the price is going down. And often at these levels, there's a whole lot of orders sitting. So when you hit a resistance level, there might be a whole lot of sell orders at that level because traders see that as a good place to get short, and then the price sells off. But interestingly, if the price breaks through these levels, then you have a whole lot of stop orders. And when these stop orders are triggered, they can help accelerate a new trend. So they're important from two perspectives in this case. So they're important because often there's a lot of sell orders at resistance levels, buy orders at support levels, and then below these levels are all these stop orders that can really accelerate a new trend. And we can see here a couple of examples on the charts. Now, when I look at these, I'm not necessarily trying to be super precise with where I'm putting support and resistance levels. I'm just looking at where I think it's going to be important for us to take note of the price. So again, from a classical technical analysis point of view, these might not be 100% technically correct, and there's different arguments for how you draw support and resistance levels. So I'm not too concerned about that. I just want you to include one way of assessing them in your model, and through experience you'll sort of figure out what works. You'll see it in so many times over and over and over again, but just make sure you include this as part of your model. And we have one final example here. And you can see this very strong support and resistance level. This is on the NZD USD again, where we retested the resistance level a number of times, and each time we touched that level, it led to this rapid sell-off in the price. And you can see if you're trading this chart at this point in time, you got to take note of this level. It's really, really important. So I'll finish off with a couple of points. So if you've got your own technical analysis tools and techniques, then sure, you can add them in. So add whatever spice you need to the model, that's totally fine. I think the key thing here though is you just don't want to overcomplicate things. You want to look at a chart and get clarity about what's going on. So the idea is for our price model to give us a clear picture of what might potentially happen next. So if you add too many tools to a chart, then you can get a little bit confused. So I like to think just have one tool for the job. Like you don't need 5 different things that tell you when the market conditions are overbought and oversold. And some might give you different readings, and that's okay. Just find 1 or 2 at max that works for that particular job. And the other part here is we're not talking at this point about a trading plan. And I'm trying to give you some practical advice how to use these things in your model. But at this stage, we're not creating a trading plan. We're just trying to build a model of how the market operates and what the price tells us. So later, we then can create a strategy where we might add more indicators or tools that help us to develop a way to trade the model. But now we're just trying to gain an understanding and not actually have this plan of how to trade it. So I just want you to think about these 2 things because they're very important context to have. So in the next session, we're going to go into dealing ranges, and dealing ranges will give you the insight into why the markets are moving as they do. And I think it's pretty interesting and important information, because you need to understand what's going on behind the charts, and that gives you an important insight into how to actually trade. So we'll cover that in the next session. Now, a couple of other action points if you like. The indicators that I've talked about in this lesson you can get for free on TradingView. We have our own versions, so if you want to get them, then there's a form you can fill out below the video, and I'll get them added for you. You need to give us your TradingView username so we can add you with the indicators. And there's a number of other indicators that are used more for trading in there as well, so you can get them. If you want to find out more about market types, then there's a whole big lesson on this in our Advanced Forex course for Smart Traders 2.0. It's 100% free course, always will be 100% free. We give you all the information, so you can sign up for that below as well if you like. Otherwise, I'll see you in the next part of the series, which is dealing ranges. Catch you then.